Call this hearing of the Senate Taxes Committee order. The first item on the agenda is to adopt the minutes from January 10th. Are there any corrections to the minutes? Seeing none, the minutes are approved as presented. Third item is to take public testimony on the memo that was explained and reviewed by Senate Counsel Fiscal yesterday, and we have organized it to ask people to speak only to the article that is before us. And so the article that is before us is Article 2, and I would like three of you to come up at the same time. We're going to go very fast here, make your point, and step back. So Michaela Rosard, and please forgive me if I mispronounce your name, Heidi Swank and Alex Stepanek. 1, 2, 3. Who's not here? Here. Mr. Bagnoli, who are you testifying on?
Madam Chair, I'm Heidi Swank. I think she is going to be on the Zoom.
She is not in. Michaela Rosard. I did not mean to be rude, but I do want to be efficient. Michaela Rosard, please identify yourself and give us your testimony. And you don't need to give all kinds of identifying information about who you are. Just tell us.
Madam Chair and members of the committee, my name is Michaela Rosard. I'm a partner at Groove Investment Group, Minnesota's most active angel network. In 2022, so last year, our angel network wrote 130 checks into 25 Minnesota startups, totaling $1.5 million. I also serve as Forge North's fellow, leading a multi-year statewide angel activation project. I have the pleasure of seeing in action the benefits of the angel tax credit for founders and investors alike. I also bear witness to the challenges when the program is underfunded, or worse yet, isn't operational. In discussing the angel tax credit, I want to shed light on who is participating as an angel investor here in the state. Traditionally, angel investors have been reserved for older white men, but this is changing both at a national level as well as here in Minnesota. Angel investors are trending younger and no longer exclusive to the mega wealthy, and it's including more women and Black and brown investors. Also, interestingly, the professional background of who's participating is broadening. There are still successful tech entrepreneurs in the mix, which we love, but they are now being joined by nurses, pilots, professors, and others who are compelled to angel invest. Having a more diverse set of angel investors means that a broader set of entrepreneurs will get funding. I can say with certainty that the angel tax credit is top of mind and part of the decision-making process when angel investors are considering where to invest, as well as how much money to deploy. Angel investors are generally the first source of funding an entrepreneur receives. At this stage, it's too early for a bank to underwrite, and it's equally too early for institutional investors to finance. To an entrepreneur, angel investors are often the difference between bringing their idea to light or not. This phenomenon is especially true for founders with a diverse background or underserved, who typically do not share the same access to generational wealth or family and friends to tap on to help fund their startups. Angel investors take an immense amount of risk by supporting startups at the earliest stage. Naturally, there's a limited amount of financial and operational history to go off of when jumping into deals. The angel tax credit serves to de-risk these investments for those backing startups in Minnesota.
Ms. Rosard, you're running out of your time. We really want to know, do you support or oppose the provision that's in Article 2?
I strongly support the program, and I would encourage it to be expanded I would suggest funding of $30 million annually and provide permanent authorization so the program's always on.
Thank you for your testimony. Next is, I understand we have to pause before we call on Ms. Swank, so Mr. Stepanek. And Stu Laurie and Shannon Watson can come to the table.
Thank you, Madam Chair. I'm here in support of the New Markets Tax Credit Program, and we are work for Advantage Capital.
You do need to say your name.
Oh, I'm Alex Stepanek, and I work for Advantage Capital. We're an impact investor. We invest in low-income and underserved communities across the country, and last year worked with Senator Nelson, Senator Rest, Senator Dietzick in crafting a bill that has worked across the country in 14 other states and has been a federal program for the last 23 years to craft a bill that really works for Minnesota and provides funding for small businesses in low-income and underserved communities.
Thank you very much. Mr. Laurie.
Thank you, Chair Rest and members of the committee. For the record, my name is Stu Laurie. I'm the Government Relations Director for Minnesota Farmers Union, and we submitted a brief letter outlining 4 provisions that we support throughout the 22 omnibus package that was agreed to. But the letter, or the article that I'm here to testify in support of is Article 2, and I specifically want to share our strong support for the changes in that article that would expand the beginning farmer tax credit to family members for sale of agricultural assets. We join a broad array of agricultural organizations in advocating for that change, including the Farm Bureau, the corn growers, the soybean growers, Minnesota Milk, Land Stewardship Project, Compeer and Ag Country, the pork producers, and a number of other organizations. Access to land and capital are central challenges for beginning farmers, and any new farmer we can get on the land is a win for Minnesota. I'll also highlight briefly that we strongly support a broader expansion of that program that would improve access for emerging farmers and better allow the department to better administer that credit. And I'll remind the committee that that credit needs to be reauthorized this session because it expires in December of 2023. So thank you, Senator Weber, for your leadership last session and advocating for that provision and leading on that bill. And I'd be eager to talk to any committee members about the changes we want to pursue this session. Thank you.
Thank you, Mr. Laurie. Ms. Watson.
Thank you, Madam Chair. Shannon Watson, Senior Director of Government Affairs and Policy for the Medical Alley Association. We are highly in support of Angel Tax Credit for 3 reasons. The Angel Tax Credit keeps Minnesota companies and Minnesota investment dollars in the state. Every year, there are qualifying companies and investors who are unable to take advantage of the program because the fund is oversubscribed. And third, investing in innovation in diverse homegrown companies is a very good way to recession-proof our state economy. We want to thank the members of the committee who have been chief authors of this provision in the past, and please let us know if we can do anything to help keep this going.
Thank you, Ms. Watson. Ms. Peterson, Ms. Martin, Ms. Kadoon.
Shep Harris will be testifying for Ms. Martin.
Welcome to the committee. I understand Mr. Harris will be testifying using the slot that was given to Ms. Martin. Ms. Peterson.
Thank you, Madam Chair and members. My name is Roz Peterson, and I'm the Public Policy Director for NAOP, which is a leading commercial real estate group that largely has commercial and industrial properties and is 600 members strong with developers and owners. And I'd like to thank the 2022 Conference Committee for including language in the bill removing the sunset for the historic rehabilitation structure tax credit. Preserving older buildings for future generations will enhance our communities, and typical funding for these projects takes multiple years to process. Many of these projects simply would not move forward without this credit, so thank you.
Thank you, Ms. Peterson. Mr. Harris.
Thank you, Madam Chair, members of the committee. My name is Shep Harris. I'm with Frederickson and Byron, and I'm here, as Madam Chair said, I'm here on behalf of Aaron Martin from Minnesota After School Advance and Youth Prize. On behalf of 1,500 Minnesota children, they want to thank you very much for including critical updates to the K-12 education tax credit in Article 2 of last year's Tax Conference Committee agreement. Members, I'm just going to do this very quickly. There's, you may see either on your computer or maybe a handout that looks something like this that breaks out the K-12 education tax credit updates. I do want to thank Madam Chair, who has championed this bill as chief author of it in the past. Senator Nelson has been very supportive of this by including it in the Tax Conference Committee agreement last year and previous years as well from the Senate. So it has bipartisan support. Basically, there's three elements to this, members. One is to increase the income limit for the maximum credit, which hasn't changed in 25 years. Yes, that's last century, from $33,500 up to now proposed $70,000. The second item would index the income limit to inflation moving forward so we don't end up with a quarter-century-old income limit again. And thirdly, switching from using the complicated, quote, household income, end quote, definition to calculate eligibility to federal adjusted gross income instead. And finally, members, I just want to give a brief statistic here, which will really, I had to double check the statistic. The need for this is critical. Youth Prize has seen a 3,506% increase. I'll say that again, 3,506% increase in demand over the past 3 years for Minnesota After School Advanced Program, which taps into this credit. And so that goes from 44 kids in 2019 up to now 1,587 kids in 2022. So the demand is there. They serve over 200 Minnesota cities, or families in over 200 Minnesota cities. So the need is critical, and we would appreciate your support and inclusion in this year's Conference Committee report. Again, thank you, Madam Chair.
Thank you. Ms. Kadoun.
Thank you, Madam Chair, members of the committee. My name is Beth Kadoun. I represent the Minnesota Chamber of Commerce. We want to thank Chair Nelson and Chair Weber and others from conferees for their work on this bill last year. For Article 2, we support the pass-through NAD option tax fixes, which would encourage you to move those along again this year, as they'll help more business taxpayers to be able to reduce their federal taxes by being able to pay taxes at the entity level. We support the small business investment tax credit that others talked about as well to help those startup companies in Minnesota. We support the R&D tax credit expansion. Innovation has been a key strength in Minnesota that we need to continue. We'd encourage you to look at some other bills that were also introduced this past year, as well as I'm sure will be introduced again, on the alternative simplified credit and other ways we can enhance this tax credit. We also appreciate the focus last year on permanent tax relief. If there was a handout in your packet that hopefully you can take a look at. As you can see, Minnesota is becoming more of a tax outlier, as many other states have been taking actions over the past 2 years to reduce their tax rates, many of them reducing their top individual income tax rates, their corporate tax rates. Because of that, Minnesota's tax rate, for example, for our corporate tax will be second highest in the nation and is scheduled to be number 1 in the nation, as New Jersey's surcharge is set to point off. This is really a self-imposed headwinds to Minnesota's economic growth. As studies have shown, that it really does undermine investment, talent recruitment, retention, and economic growth. So we encourage you to also look at permanent tax rate reductions this year. Thank you.
Thank you, Ms. Kadoun. Mr. Bernstein, Mr. Reynolds, and then we're going to have some Zoom testimony. Welcome to the committee. Please identify yourself.
Chair Rest, members of the committee, thank you for having me. My name is Eric Bernstein. I'm director of a labor grassroots coalition called We Make Minnesota. We represent the teachers, long-term care workers, state and municipal employees, and other public sector workers and public sector adjacent workers that keep the state running. I want to thank you for having me here today to talk about some of our thoughts on the conference agreement from last year. I think it's a great format to hear about what a lot of the groups that are in this committee think about some of the big tax policy issues that we will be talking about. In particular, I wanted to share our thoughts on the first tier rate reduction from last year. We opposed this provision because it jeopardizes revenues that are needed to support our schools, hospitals, long-term care workers, and many other public services. And although it was billed as tax relief for low-income households, our fiscal analysis from last year showed that the benefits would go overwhelmingly to the top 38% of the total cost would go to the top 20%, which are earners that make over $134,000 a year, according to the Institute for Taxation and Economic Policy. The cost, nearly $400 million over the coming biennium, would be substantial, while the savings for working families would be modest, or in the case of where it ended up at the end of session, almost non-existent. It was $1 per week on average for filers making under $75,000, and then nothing for a lot of earners that didn't make the threshold to qualify for the benefit. So it wasn't really a very meaningful savings for families and households, but it would cost a lot overall. I know that, you know, in a room full of tax policy folks, rate reduction is sort of a boring issue to talk about, but we wanted to speak on it just because we felt that it's indicative of a lot of tax policy changes that make small differences for families, but add up to a lot at the state level and cost us opportunities to shore up public services and make sure that things run well. Thank you.
Thank you very much. Mr. Reynolds.
Thank you, Madam Chair and committee members. My name is John Reynolds. I'm with the National Federation of Independent Business. I just wanted to say thank you to the committee last year and hopefully this year for including the pass-through entity provisions, allowing small businesses to take greater advantage of federal tax deductions will provide relief at a time when there's a lot of challenges out there on Main Street. We also echo Ms. Cadoon's concerns about the high tax burden in the state that falls particularly heavily on small businesses, and encourage the committee to look at long-term permanent tax relief that will help Main Streets in all of your districts. Thank you.
Thank you very much, Mr. Reynolds. We'll now go back to Zoom testimony. Ms. Swank, are you prepared now?
I am.
Please identify yourself, and we welcome your testimony.
All right, thank you. Senators, my name is Heidi Swank. I am the Executive Director of Rethos, an organization that's committed to rehabilitating our historic spaces, and one of the leaders of Revitalize MN, a statewide coalition of advocates working to renew the state historic tax credit. Revitalize MN represents developers, unions, preservation advocates, construction firms, architects, community members, engineers, and financial institutions across the state. I'm here to speak in support of Minnesota's historic structure rehabilitation tax credit, which was included with no expiration in the tax omnibus bill last session. As a very brief history, the state historic tax credit was originally passed in 2010 through a bipartisan effort to address job losses during the Great Recession. Since its inception, it has enjoyed broad bipartisan support in both legislative chambers, in the metro area, and in greater Minnesota. I will be brief. This is an incredibly effective tool that benefits every community in our state. Since 2010, the over 170 completed tax credit projects across Minnesota have generated more than $5 billion in economic activity and provided important leverage in funding public services through increased property taxes and adding buildings onto tax rolls. The impact of the historic tax credit is particularly dramatic in greater Minnesota, with every $1 of tax credit invested yielding more than $16 in economic activity. Not having a historic tax credit to support these projects hurts Minnesota. And for the first time since 2011, communities around the state aren't able to benefit from this critical program. Since the state historic tax credit expired in June, we have lost on average more than $150 million. 7 projects have failed to move forward, and hundreds of good-paying jobs have been lost. Many developers that use historic tax credits operate at a national scale, and Minnesota is now in a minority of states that don't provide state-level support for historic redevelopment. The state historic tax credit is one of the most effective and efficient tools and will directly impact jobs and economic development across our state. Thank you for your time.
Thank you, Ms. Swank. Next is Michelle Tran-Marins.
Hello, Madam Chair and members of the committee. My name is Michelle Tran-Marins, and I am the founder and CEO of WeSparkle, a software company that helps small business owners save time and increase their sales through our suite of AI-powered software tools. I am testifying in support of the Angel Tax Credit Program. As the founder of an early-stage startup, the Angel Tax Credit Program helped us identify people interested in investing in our company. It also incentivized people who had never been angel investors before to try it out as a way to support early-stage startups and to diversify their portfolios. Some of these investors are here in Minnesota, and some of them are from outside the state. That is why this program helps to bring more investment dollars to our state, which in turn allows us to hire and train employees, reduce the unemployment rate, and continue building talent right here in Minnesota. Since WeSparkle provides software to Main Street businesses, these investments also allow us to better support small business owners all over the state and around the world. The Angel Tax Credit Program was instrumental in helping me kickstart our startup's fundraising process, and I know it has helped other founders as well, especially for those of us who don't have generational wealth or friends and family who can help fund the startup process. I encourage you to make this fund a permanent fixture in this budget and to support it with as many dollars as you can, because these investments have and will continue to have a positive ripple effect in our economy. Thank you for your time, and I welcome any questions you may have.
Thank you, Ms. Behrens. Mr. Schwartz.
Yes, for the record, my name is Joseph Schwartz, Director and Counsel of Managed Funds Association, or MFA. MFA represents the alternative asset management industry and its investors, which across Minnesota deliver for retirement security, college education, and the important work done by nonprofits and charities through $36.8 billion in investments. Thank you, Chair, Vice Chair, honorable members of the committee for the opportunity to again present testimony and, with the Chamber, NFIB, and the Minnesota Society of CPAs, voice our support for last session's proposed modifications to the Minnesota pass-through entity tax. I would also like to thank the Department of Revenue for working and meeting with us in the last legislative session to find a solution which both enhances federal tax outcomes for Minnesotans and reduces administrative burdens for taxpayers and the department alike. Last session's Omnibus Tax Bill contained two technical amendments to the elective pass-through entity tax, a state revenue neutral measure which shifts the imposition of tax from individual business owners to the entities through which they conduct their business. In doing so, it allows those individuals to deduct for federal income tax purposes the full share of state taxes paid as a result of recognizing income from their business. These elective pass-through entity taxes are now common among states as a response to federal legislation enacted in 2017, which limits the deductibility of state taxes for federal income tax purposes to $10,000. In November 2020, the IRS gave its approval as to the effectiveness of these elective taxes. It is important not to understate the impact that an optimized pass-through entity tax can have on Minnesota residents. According to information published this past February by Treasury and the IRS, in 2017, the last year in which the federal deduction for state taxes was not limited, Minnesotans claimed an aggregate federal deduction for state taxes of $13.7 billion. In 2018, the first year in which the federal deduction for state taxes was limited, that number fell to only $2.7 billion. In other words, and here I'm assuming that the average effective tax rate for Minnesotans claiming this deduction falls somewhere between the lowest and highest marginal tax brackets, the limitation on the deductibility of state taxes amounted to between a $1.1 billion and $4.1 billion cash tax hit to Minnesotans' pocketbooks, some of which is certainly at the expense of small and medium-sized business owners for which a fully optimized pass-through entity tax would have and still could provide much needed relief in the ensuing economic conditions over the following years. Suffice it to say, on substance, the technical amendments relate first to eligibility to elect into the tax, and second to optimizing tax results for Minnesota residents. For these very reasons of both expanding the scope of businesses that can elect into the tax, as well as fully translating the state tax impact to individual business owners to a federal deduction, we are strongly in support and urge this committee to look favorably upon continuing to support this legislation in the current session. Thank you.
Thank you, Mr. Schwartz. Todd Koch.
Good morning. My name is Todd Koch. I am a CPA. I'm a partner at the firm John A. Knutson & Company, firm that's based in Falcon Heights, Minnesota, with a 95-year legacy of assisting businesses and their owners. I'm also a member of the MNCPA. I'm here to talk briefly about 3 provisions that we're in support of. One is the pass-through entity tax changes. Pass-through entity tax is a way to support Minnesota businesses by allowing them to deduct state income taxes on business income on their federal return. This allows Minnesota Main Street businesses to have similar benefits to Wall Street businesses. It expands the entities that are allowed to use this pass-through entity tax option. It also clarifies some rules and makes it easier for business owners to qualify for the pass-through entity tax. The changes have a nil impact on Minnesota tax collections. We have a rare opportunity to simplify tax compliance and support small businesses with nil impact on tax collections. We'd appreciate your support of this rare opportunity. Also within Article 2, there is a provision talks about allowing Minnesota estate tax portability. It's very rare for our clients to have to file a federal estate tax return. It's becoming more common to file a Minnesota estate tax return. This is because the Minnesota estate tax exclusion of $3 million is less than 25% of the current federal exclusion of almost $13 million. But in a federal estate, if one spouse does not use the $13 million exclusion, the remainder moves over to the surviving spouse, thereby allowing the couple the full use of both spouses' exemptions. This dramatically simplifies tax planning as a simple, what I call an I love you will works. That's where one spouse gives all the assets to the surviving spouse, and the unused exclusion moves over, thereby making planning easier, and you don't have to pay for sophisticated planning to use both spouses' exclusions. A simple I love you will, however, does increase Minnesota estate tax in many cases. The Minnesota exemption for a couple is often just one spouse's exclusion due to the lack of portability. Without portability, a couple with an I love you will could pay tax of almost $400,000 more than a couple paying for planning. Why should couples have to pay someone like me to develop plans and add stress to their planning? Why shouldn't an I love you plan be taxed any different than people that hire someone to develop a sophisticated plan? This is not a tax reduction for the wealthy. This is really a tax simplification measure. We are asking that simple plans be taxed similar to sophisticated plans. People that have the means to pay for a sophisticated plan should not have a lower tax than those that do not. The last provision I want to talk about is the renter's tax credit in Article 8. This is an excellent idea to move the renter's tax credit onto the income tax return. This accelerates getting dollars to those that often need the money the most and simplifies filing for not only Minnesota revenue and the taxpayers at all. I'd like to thank you for addressing these tax issues so early in the session. By addressing this bill early, a bill which includes issues which have had bipartisan support, will allow Minnesotans to pay the correct tax, no more, no less, and will reduce compliance costs. Thank you for addressing these issues so soon.
Yeah, thank you, Mr. Koch. I want to make clear, we do not have any bill in front of us. We are merely taking testimony on the conference committee report from last year as a way of reviewing the issues that may come before us. I believe it is Senator Dames who has the portability, and we are not going to put the I love you language in the state statutes. We're just not, maybe the House will do that, but the Senate will not do that. But thank you for bringing it up. Senator Dames' bill is going to get a hearing, and he knows that. Thank you very much, Mr. Koch. So we'll move on to, before that, I am so impressed with the way in which this technology at least has developed over here in the Senate. I'm assuming they have something similar in the House. When we were planning the restoration and not really in some instances in this room, modernization of the Capitol. Prior to that, we had blocked out people who were using a screen on the left side of the room here, and people couldn't, had to sit behind it, but there was no room. And this is a very superior way, and I had brought it to the attention of the construction architects, whoever it was, after having gone, must now be 5 or 6 years ago, to a presentation where they used the TV monitors set on the floor so that no one's sight was bothered or limited when a presentation was being made. I think it's, from my point of view, this is the first time we've used it, this hybrid format in this committee. It is available. It's not available to lobbyists. As you know, you have to be here in person. But for others, it's going to be a very useful tool, so I'm glad we have it. Article 3, Mr. Demerit is here on Zoom or virtually. Welcome to the committee, sir. If you'd identify yourself for the record.
Good morning, Chair Rest and members of the Tax Committee. My name is Seth Demerit, and I am the Manager of Regulatory and Rates for CenterPoint Energy. CenterPoint Energy is one of 4 utilities in Minnesota that was impacted by the gas spike in February of 2021. This increase in natural gas prices resulted in extraordinary costs of about $400 million in a 5-day period for CenterPoint Energy and its customers. In normal course, during the winter months, these costs would have been sales tax exempt for our residential customers, but due to the collection of these costs over a 63-month period as approved by the Minnesota Public Utilities Commission, our customers would be subject to the sales tax of about $7. CenterPoint Energy supports this bill and offers relief to our customers for costs that typically would not have been subject to sales tax. Thank you for your time this morning.
That's Jamie Fitzke. She's just up.
Thank you very much. Let's see.
She's not here. So Patty
Patricia Naumann, I guess. Jeff Pellegrom is not here. But thank the other two of you, too, for being willing to step forward. Ms. Naumann.
Thank you, Madam Chair and members, for the opportunity to speak to you this morning about House File 3669 and Article 3 in particular, and I'll be very brief here for just one moment. There are various construction materials exemptions that were included in that bill for specific projects, and I just wanted to offer some comment that Metro Cities, representing cities throughout the 7-county metropolitan area, does support simplifying that construction sales tax exemption process overall. State law that was enacted in 2013 does provide this exemption for local governments and other entities, but due to the very cumbersome process, sometimes the actual receiving of that exemption or accessing of it can be very cumbersome, if not prohibitive, for local governments to access. So I would just encourage, as you go along and consider a tax bill for 2023, to consider addressing that overall construction sales tax exemption so that all entities that are entitled to receive that exemption under law are able to utilize it without the need for special legislation.
Thank you, Ms. Millman. We do look forward to getting an updated revenue estimate.
Thank you.
On the proposal when it comes out.
Thank you very much for your time.
You bet. Article 4. Mr. Carlson, Mr. Hilgart, and Mr. Martinez.
Thank you, Madam Chair, members of the committee. My name is Gary Carlson. I'm with the League of Minnesota Cities. We generally come to this committee on articles related to property tax, sales tax, economic development, and TIF. The public finance article, and I think that's pretty much it, but almost every article in the bill, and sometimes even the state tax issues as well. Specific to Article 4, Madam Chair and members, we support the homestead market value exclusion increase that was included in the bill. That program was established in 2011, and those triggers and thresholds have not been adjusted since. We know that this year we had a record increase in the homestead market values across the state of Minnesota, over 17% on average, and this would be one way to really help those homeowners with effectively an increase in that exclusion. Also, we do have some concerns along with Metro Cities, Ms. Nauman, who was just here, on the 4D property class rate change. That does create some major property tax shifts in certain jurisdictions. We do appreciate the fact that you have included a municipal consent piece as well as a state aid piece. However, the state aid piece is temporary, and so some of those shifts would occur, and we'll continue to work with you on that, Madam Chair. Finally, the affordable housing market value exclusion development tool that was included in the bill, we have concerns about the scalability of that program. It would only allow a 50% exclusion of value as a way to incent the development of affordable housing. In some cases, it might be advantageous to be able to scale that exclusion so that it would match the project more effectively. And then, Madam Chair, there's a few other article pieces that if I could briefly mention, or would you rather me not?
Very, very briefly, you
Okay.
don't have to keep coming back up.
Right. Article 2, we support the historic structure rehabilitation credit. Article 3, as Ms. Nauman indicated, we will work on the construction sales tax exemption simplification. Article 5, Mr. Peterson will talk about the LGA effort and Senator Klein's bill last year that we worked on. We do support updating that formula. Article 6, we appreciate the auditor working on the TIF policy changes. We spent quite a few months last year, and again, we had a meeting this year that will update that proposal, but we appreciate Auditor Blaha and Jason Nord's work on that. Article 7, the local option sales tax general election date. We would like to clarify that per what was in the bill last year to say the first Tuesday after the first Monday in November. And then finally, Article 10, the homestead credit refund increase. We do appreciate providing some additional relief to homeowners as well. Thank you, Madam Chair.
Thank you, Mr. Carlson. Mr. Hilgard.
Madam Chair, members of the committee, my name is Matt Hilgart. I work for the Association of Minnesota Counties. The association represents all of Minnesota's 87 counties. Thank you for the time today. I am actually coordinating my testimony with Mr. Mossman, so I don't have to come back up here for other articles, so I will focus my testimony on behalf of AMC and MICA on the property tax policy provisions in Article 4. Much of what Mr. Gary Carlson said, we are very supportive of your efforts to address the market value increases and property tax pressures that Minnesotans are facing right now due to these historic market conditions. As such, we very much support the expansion of the homestead exclusion, the PTR, the targeted PTR, and the senior property tax deferral. Madam Chair, I'll end by just saying something that you started yesterday, which I thought was a very worthwhile conversation, that you coined the insufficiency of the property tax system. I hope that articles in this bill will be considered this year, but I also hope that the committee will urge caution to things that reduce the tax base. There are several things included in this bill that do that. And we are concerned that when you are limiting tax base, you're putting additional pressures on taxpayers. The most notable example in this bill is what Gary Carlson said about the new affordable housing market exclusion, but also it's a good reminder that the disabled market value exclusion, which is also included in this bill, is a great program, but funded by the erosion of tax base. That erosion of tax base started at roughly $1 billion of total value. It has grown to more than $3.3 billion. So communities with VAs, Carlton County is the biggest offender of this one, is disproportionately impacted by this on their tax base. So thank you very much for your time, and thank you for your attention to the property tax relief conversations.
Thank you, Mr. Hilgard. I believe that the last provision that you mentioned, however, is also scalable. So we'll be taking a look at a number of things like that. Thank you. Mr. Martinez.
Yeah, good morning, Madam Chair, members of the committee. My name is Jean Paul Martinez. I'm the Chief Financial Officer of Connexus Energy, Minnesota's largest member-owned electric utility, serving 145,000 accounts. Senator Putman, thank you for your service to the Connexus members living in the southern corner of your district near St. Cloud. Today, I speak in support of the bipartisan provision related to energy storage systems, which was included in the 2022 Tax Omnibus Bill and included here in Article 4. Conexus has served members during the past 5 years with flat rates, no increases, while benchmarking in the top 5% of all utilities nationwide for electric service reliability. Among many initiatives, Conexus built and have operated since 2019 the largest solar battery facility in the upper Midwest. With these technologies, we have been able to offset millions from more costly wholesale power purchases. We see additional ways for energy storage to benefit the communities we serve. Batteries can be used as a strategic tool. It has many features and uses, and we see them as a key factor in developing the Minnesota grid today and into the future. It is in the interest of Minnesota taxpayers, all of whom value affordable and reliable electricity. The evolving electric grid needs tools to enable by economics and trust rules understood by all electric utilities. It is about clarity of policy and enabling economics to benefit all Minnesota electric consumers as our grid utilities and operators implement the tools it needs. As an electric cooperative, Conexus also supports a bipartisan provision in the 2022 tax omnibus that's championed by the Minnesota Rural Electric Association related to electric grid attachment and appearances, and also is included in the 2022 tax omnibus bill. Madam Chair and members of the committee, thank you for your time and consideration.
Thank you very much, Mr. Martinez. Next, we have Sam Walseth and Andrew Doer, and then we'll have someone on Zoom.
Madam Chair and members.
Welcome to the committee.
Thank you. Sam Walseth, lobbyist for the Minnesota Rural Education Association, and here to speak in support of the first bullet in Article 4. This provision would include all forms of educational cooperatives for purposes of the existing lease levy authority that metro area schools currently access to support their intermediate schools for deferred maintenance issues. Unlike the metro area intermediates, rural school districts have formed special education cooperatives or joint powers districts, typically to provide high-need special education services or career and technical educational programs. Yet these similar entities are missing a very important fiscal tool to assist them with deferred maintenance needs. This levy authority is very modest. It carried a levy impact note last session of $1 million across the state. It was initially introduced in Senate File 389 by Senator Dames, House File 498 Marquardt Davids. As staff mentioned yesterday, sometimes education provisions find their way into the tax committee, as this one did last session. Regardless of this year's pathway, we hope the legislature will see fit to get it across the finish line. It is very important to make sure that our high-needs students and the staff who serve them are operating in very safe and healthy facilities. Thank you for your time, Madam Chair.
Thank you, Mr. Wilson. I believe I also mentioned with regard to that it's not carrying the language in the tax bill. It's carrying the costs that I believe belongs in a different jurisdiction. Thank you, Mr. Wilson. Mr. Doer.
Thank you, Madam Chair and members of the committee. For the record, my name is Andrew Doer, and I'm here today representing the Minnesota Pork Producers Association and the Minnesota Soybean Growers Association. And we're here today to offer our support for the provision in Article 4 in last year's conference report that raises the ag homestead valuation limit for first-year rate to $2.5 million. Also spoke with Mr. Laurie, who you heard from earlier, and he wanted me to offer the Farmers Union support for this provision as well. The last time that the legislature set a baseline limit for ag homestead valuation was in 2010, and it was set at about $1.1 million. And while the Department of Revenue does adjust that number each year, and as ag valuations are going up, it adjusts up, we don't feel that that number has really kept up with what an economically viable farm is in the state of Minnesota. To give people an idea of the size of a farm in that valuation limit, and it will vary greatly from area to area, but we figured an average farm at the current rate that fits within a homestead is about 250 acres. And if this provision was passed, raising the baseline to 2.5 million, we estimate that it would add about 80 acres to that homestead, which is significant for small and medium-sized farmers to keep farming. And to give an idea what the average farm size in the state of Minnesota, the USDA estimates the average farm size in Minnesota at about 377 acres. So this, with this provision passed, it would still be a below average size farm that would fit within the ag homestead limit. With that, Madam Chair, I appreciate the opportunity to testify this morning.
Thank you very much. Mr. Fulton, City of Duluth, are you on the Zoom?
Yes, I am. Thank you, Madam Chair. My name is Adam Fulton. I am the Deputy Director of Planning and Economic Development for the City of Duluth. I'd like to thank the committee for taking up aspects of last year's bill. We continue to seek modifications to the property tax exemption limitations around airports in support of new private business investment around the Duluth International Airport. The proposed legislative change will incentivize capital investment and will increase the overall tax base of the state. It will have a significant and positive impact on both Duluth and the state's economy. Critically for us, it will support continued innovation in the aviation sector in Duluth, with Cirrus Aircraft in the lead. The proposed change will provide for a net tax capacity rate of 50% for aviation businesses located at airports in cities with populations between 50 and 150,000 people, focused on Duluth, Rochester, and St. Cloud. Under current legislation, businesses located at airports in cities with populations below 50,000 currently pay no property taxes, while cities with populations over 50,000 pay 100% of the total net tax capacity. Cirrus is making transformative investments at its Duluth headquarters. Cirrus recently purchased the former Northwest Airlines maintenance base in Duluth from the Duluth Economic Development Authority, is transforming it into an innovation center. This is a 189,000 square foot building, and it's going to allow Cirrus to add 80 new engineers to its current team of 300 engineers, scientists, and technicians working on innovation and new product development at this facility. The immediate private reinvestment here of over $10 million in this facility means those jobs stay in Duluth and allows for an expanded corporate presence in Minnesota. The proposed change to tax structure at airports will not reduce levy amounts collected by the taxing jurisdictions, and it has a minimal impact to other taxpayers in Duluth. It's going to increase the fairness for aviation businesses at the airports, addressing other additional lease expenses around the airport that must be borne anyway due to the nature of property ownership surrounding the airfield. Businesses located around the Duluth International Airport pay approximately $2.3 million in lease expenses on top of current property tax amounts. And those lease payments are critical for airport operating costs because airports do not have levy authority. And so they must provide other means of cost recovery to maintain their operations. We hope that the Senate Tax Committee will support this proposed tax language modification in support of economic investment for the Minnesota's aviation economy and in Duluth's capabilities as a national center for aviation innovation and excellence. I want to thank the committee for the opportunity to speak today.
Thank you, Mr. Fulton. Senator Hauschild, are you carrying that legislation this year?
Thank you, Madam Chair. I'm happy to look into it and be an advocate for
Okay, thank you.
that policy. Thank you.
An extraneous comment. You know, sometimes I think most of us get very strange autocorrects on a text, and I'm waiting for a communication from the Department of Revenue. They're very good sports, but it auto-corrected to Department of Revenge. What can I say? Okay. Article 4. Ms. Brown, are you on Zoom?
Yes, Madam Chair, I am.
Go right ahead.
Okay. Thank you. Thank you, Madam Chair and committee members. I'm Virginia Brown, Chief Transformation Officer at AON. AON is one of Minnesota's leading nonprofit affordable housing providers. Since 1986, we've built, purchased, or renovated almost 6,000 housing units in the Twin Cities, and we provide housing stability to more than 17,000 Minnesotans each year. I address you today as one of 20 organizational members of the 4D Coalition. This coalition of nonprofit and for-profit affordable housing developers and operators collectively provides more than 90% of the state's low-income rental properties. Over the past 4 years, the Senate has consistently and bipartisanly supported a statutory change to simplify and lower the property tax rate on Class 4D affordable housing rentals. Because of the work done by you, Madam Chair, along with Senators Weber, Klein, Nelson, and others last year, we were gratified to see this desperately needed relief contained in the unsigned Omnibus Bill Tax Bill Conference Committee report, which your committee staff noted in yesterday's presentation. We respectfully ask for your support again in this year's Omnibus Bill. For the past decade, the state's policy, which I know you, Madam Chair, authored, has recognized the importance of treating low-income rental units, so-called Class 4D properties, more favorably in the taxation of real property than market rate housing. Unfortunately, we've seen property taxes on our affordable rental units skyrocket as market rate properties valuations have dramatically increased our low-income units valuations. As a result, this imposes enormous pressure on our operating budgets, causes many of us to dip into our reserves just to pay for higher property tax bills, force many of us to delay making the sorts of improvements to our properties which would benefit our residents and the community, and in some cases made certain properties no longer sustainable as affordable units. Finally, and most importantly, it keeps critical dollars away from developing more housing, which our state so desperately needs. The direct cost to the state would be very small for this change relating to the property tax refund program interaction. Committee and Revenue Department analyses in the past have shown that this change would result in only very modest property tax shift in most affected municipalities. We're committed to work with you and stakeholders to address any concerns and to ensure that the resulting tax savings would be used for reinvestment in our properties and to incentivize the development of new affordable housing. Again, I want to express our coalition's appreciation for your interest in addressing this pressing problem and our great willingness to provide you information and testimony when appropriate. Thank you so much for the time today.
Thank you, Ms. Brown. I invite Ms. Cadoon and Ms. Peterson back, and Mr. Derek Moe. Ms. Cadoon, go ahead.
Thank you, Madam Chair. Members of the committee, my name is Beth Cadoon. I represent the Minnesota Chamber of Commerce. We thank the committee for their work to reduce the state levy, especially the Senate Omnibus Tax Bill, that include the full repeal of the state levy. And that's the extra tax paid by businesses in addition to all their local property taxes. We would urge the committee this year to support further reduction of the state levy, as this is still a very high fixed cost of doing business in our state. There was also a property tax run that was provided after session ended regarding the tax shifting that actually occurred onto other property taxpayers. The property tax system, as you know, is very intertwined. So if you reduce taxes on one type of property, it will cause their tax burden to be shifted onto other property taxpayers unless there's some other interventions occurring. The final agreement did cause a shift that resulted in increasing taxes on businesses, apartments, and some other properties, especially hit those small businesses. Statewide, the first tier of CI went up by 1.57%. And this shift was even greater in greater Minnesota, as the first tier of CI went up by 1.87% and the second tier by 0.82%. It sounded like this was not the intended result, but I would urge the committee to take those interactions into consideration and enact other changes so that the end result is not a property tax increase on the business community or apartments, as we have certainly heard about concerns on housing affordability as well, especially with an $18 billion surplus and as businesses and taxpayers continue to struggle with rising inflation and other cost increases. Thank you, and I'll look forward to working with you this session.
Thank you, Ms. Cadoon. Ms. Peterson.
Thank you, Chair Brest and members. Good morning again. Roz Peterson with NAP. And we'd also like to thank the Conference Committee for including a reduction to the state general levy, which is, as you know, an additional property tax burden placed on businesses. Commercial and industrial properties already pay their fair share of local government taxes, including schools, and the general levy is on top of that, as you know. In most multi-tenant buildings, this tax is passed through to the tenants. So people who run nonprofits or immigrant families running an ethnic restaurant are the people who pay this tax. With a historic surplus, an ever-changing commercial real estate market, people facing workforce challenges, increasing supply and borrowing costs, we are asking you to consider reducing the levy even more to assist businesses of all sizes. Previous legislatures have chosen largely to provide relief through exempting the first $150,000 of value, which can create winners and losers across the state and does not help small businesses that are part of a multi-tenant building. Instead, we strongly urge to reduce the overall levy amount, which will provide relief for all people. And again, I want to thank my good friend Chair Rest for the opportunity to speak today, and we look forward to working with the committee as we move forward through this session. Thank you.
Indeed. Thank you, Ms. Peterson. Mr. Moe.
Good morning, Chair Rest and committee members. My name is Derek Moe, CEO of the Minnesota Rural Electric Association, representing all 50 of Minnesota's rural electric co-ops, serving 1.7 million Minnesotans with electricity. I'm here to testify on Article 4, Cooperative Electric Associations, the modified definition of attachments and appurtenances. Current law exempts cooperative distribution lines along with all attachments to those lines from personal property tax, a provision that was adopted in 1939 as leaders in rural communities formed rural electric co-ops to do the expensive job of bringing electricity to rural Minnesota where no one else would. I thank Senator Weber for carrying this bill and achieving broad bipartisan support and bicameral support in the last session. It was adopted by the committee, clarifying and affirming that attachments, including meters and streetlights, are exempt from personal property tax under Minnesota statutes, consistent with longstanding practice. This is needed because in the last 2 years, several electric cooperatives have received increased tax bills tied to meters and streetlights. People's Energy Cooperative, for example, got a 27% increase in their property taxes. This is despite an 80-year precedent for interpreting the language to comprehensively exempt equipment tied to the distribution system. It is bewildering that meters clearly attached to rural electric cooperative distribution lines are suddenly taxable when they have been exempt for 80 years. Because electric co-ops are not-for-profit, collecting only what we need from our members to pay our costs, these increased tax bills flow directly through to end-use electricity consumers. And since our primary goal is to serve those consumers well and affordably, this concerns us greatly. We'd also like to express our support for the energy storage exemption brought forward by Connexus a few minutes ago, which benefits co-ops at large as well as the ongoing energy transition. And I thank you for your time this morning.
Thank you. Mr. Reynolds again, and Mr. Ager.
Thank you again, Madam Chair and members of the committee. John Reynolds with NFIB. Since there's a new member or new members of the Senate, I just wanted to explain. NFIB represents over 10,000 small businesses in every corner of the state, in every industry. 90% of our members have fewer than 20 employees, and our average member size is 10 employees and $500,000 in revenue. So we're talking generally very small businesses. I don't want to repeat what Ms. Kadoun and Ms. Peterson testified to, but we too appreciate the reduction in the state general levy. The Minnesota's general levy is sort of uniquely burdensome among states that have that type of tax, statewide property tax. The business property tax bill is 3 times higher than the next highest state. So we also encourage the committee to go further in reducing that levy and giving small businesses relief. We also share the concerns that Ms. Kadoun raised about and Ms. Peterson raised about the net effect of the property tax changes in the conference committee report from last year. Commercial property values around the state, like residential property values, have also risen significantly over the last 3 years, and small businesses across the state are seeing increased property tax bills as well. And as Ms. Kadoun noted, the shift tends to fall hardest on small and first-tier and second-tier properties in greater Minnesota. So a lot of challenges on Main Street right now. Can't hire workers, still have supply chain disruptions, still dealing with inflation. So we hope the committee, we agree that this is likely an unintended consequence and look forward to working with the committee on mitigating and eliminating the impact of those property tax changes. Thank you, Madam Chair.
Thank you. Mr. Ager.
Thank you, Madam Chair, members of the committee. My name is Paul Egger, and I'm Senior Vice President of Governmental Affairs for the Minnesota Realtors Association. Thank you for the opportunity to testify on a few items, property tax relief items in Article 4. Madam Chair, I'll just note we also support the provisions in Article 10 on the homeowner property tax refund and the targeting refund. In Article 4, I just want to echo Mr. Carlson and Mr. Hilgert's support for the homestead market value exclusion, which I believe you were the chief author of, Madam Chair, as a standalone bill. Just to, I don't want to repeat what they said, but just to provide a little bit more context, to where home values were when that program was created and where they are now. I look back at our association's 2012 annual market report, so 11 years ago, and the median sales price of a home that year was $149,000. In November of this year, year to date, the median sales price was $329,000. So it seems definitely time to take a look at those values within the homestead market value exclusion language and bring them up to date with where values are currently. Also in Article 4, Madam Chair, just want to echo the support that you've heard from previous testifiers for addressing the state general levy and making reductions and phasing out that provision. And also want to share our support for the provision that was in the bill in the conference committee agreement, increasing the household income limit and reducing the number of years a homeowner must own and occupy the property to qualify for the senior citizens property tax deferral program. We think modifying that eligibility criteria is reasonable and will provide some seniors struggling to pay their property taxes with an option to age in place. And with that, Madam Chair, thank you for the opportunity to testify today.
Thank you, Mr. Ager. Article 5 now then, Mr. Mosman, Mr. Zart. I don't know if Ms. Nauman needs to comment on other provisions. If so, if she would come forward.
Thank you, Madam Chair and committee members. Matt Mossman with the Minnesota Inter-County Association. My comments on Article 5 are on behalf of MICA and AMC. Our associations support increased county program aid and increased payment in lieu of tax payment amounts for certain publicly owned tax-exempt lands. Regarding CPA, we appreciate the bipartisan effort last session to increase county program aid and LGA together by $30 million. We do urge a larger increase in CPA and to index that appropriation to inflation. CPA is not indexed to inflation, and in fact, CPA appropriations are at roughly the same level as county aids were at 20 years ago. Had county program aid simply kept pace with inflation, annual CPA appropriations would be over $150 million each year higher today. In short, we believe a substantially higher increase is both needed and justified. Regarding PILT, we continue to support the increase from $2 to $3 per acre in payment levels for county-administered other natural resource or tax-forfeited lands and DNR-administered lands. Under current law, these payment reimbursement rates are substantially lower than for other PILT categories, and increasing these rates would enhance the equity in the payment rates across the various PILT categories. I would just really quickly say that we also support the construction materials sales tax exemption universally for the refund exemption. And with that, Madam Chair, thank you for your time. Be happy to answer any questions or work with the committee as the session moves forward.
Well, Mr. Mossman, you did raise a point that I think we're going to be looking at in any number of areas, and not just in the tax committee, and that is how we're going to understand inflation and its impact on any number of appropriations, taxes, and if we use the consumer price index, which one are we going to be using here? We use chained CPIs, I'm sure you're aware. It's a different one in Social Security, for example. But we had so many years of inflation being at or near zero that it seems to me we have to be careful in looking at all of that, not to over-predict, I guess is the word, I mean, it's not a word, but anyway, the concept of just what role and what principles we'll use with regard to accounting for inflation, including that general bill that Senator Marty has that I'm assuming will be taken up at some point. But thank you for bringing that up. Mr. Zart.
Well, thank you, Chair Rest and members. My name is Shane Zart. I'm a senior attorney and lobbyist with the firm Flaherty & Hood, and here to testify today on behalf of our client, the Coalition of Utility Cities. The Coalition of Utility Cities is a group of 7 cities that host the state's largest investor-owned power plants. And as nonpartisan staff summed up yesterday, for each of these communities, Sometimes the plant alone is between 40 and 75% of their tax base, and longtime tax committee members are familiar with some of the issues that comes along with that, especially when that property is state assessed property by the Department of Revenue. But what it was in Article 5 last year were some provisions that start to look at how do we account for these communities when those plants retire. As some of them are headed for the retirement in the next 10 to 15 years. So I want to express the coalition's support for the energy transition account provisions in Article 5, but with a caveat. As Mr. Arneson did a good job, I think, of noting yesterday, what was in last year's conference report was essentially a placeholder. It set aside some language, but even had that passed, what was in the bill basically left it to a future legislature to come back and flesh out the policy and the distribution of that. So even if the bill had passed, we'd still be urging you to have the same conversation this year that we're going to be urging you to have. But we do feel that the final version that was in the Senate's Omnibus Tax Bill as it headed to conference is a great starting point for that discussion. Senator Weber, as Property Tax Division Chair, provided some input that helped shape that. Other senators throughout that. The bill got better, frankly, because of the Senate last year. We hope it will continue to be, and we hope that it will have your consideration this year. So thank you, and on behalf of those communities who are going to be deeply impacted by this and soon, look forward to working with you. And I think the last note I would leave you with is that the passage of time has only made this provision more urgent. And for a city like Becker, the first of the 3 Sherco units that will be retiring, all of them by 2030 will retire this year. So this is a perfect time to look at this provision. We look forward to talking with you about it.
Thank you, Mr. Zart. Ms. Nellman.
Thank you, Madam Chair and members, again for the opportunity to comment. Metro Cities would like to provide comment on the local government aid provisions that were included in last year's tax bill. And just to briefly say that Metro Cities does support modifications to the LGA formula, basically updates that were developed and proposed last year but not considered in the final tax bill agreement. Those updates are meant to ensure that the formula factors do remain valid and current in predicting city needs. And they were developed and agreed to by the 4 city associations. So we do continue to review those factors and do continue to support those updates in consideration of LGA changes this year. Metro Cities also does support an increase to the formula appropriation for local government aid, and at a more robust level than was included in last year's bill to reflect those inflationary costs that you were discussing and that we certainly support, and also in recognition that the appropriation has not adequately kept up with those costs over the years, basically since for the last 20 years. So thank you, Madam Chair and members, for the opportunity to comment.
Thank you, Ms. Nellman. Mr. Peterson?
Thank you, Madam Chair and members. My name is Bradley Peterson, here on behalf of the Coalition of Greater Minnesota Cities, representing over 100 cities outside of the 7-county metro area. It's a great day to talk about local government aid, our priority for this session and most sessions. And as it results to the provision that was in Article 5, we would have to give that work an incomplete. As others have noted, the LGA appropriation has not kept up with inflation. It also, over time, has become a smaller and smaller share of state government spending as a reflection of the general fund. Additionally, as Ms. Nauman alluded to, there was significant work done in 2020 with the League of Minnesota Cities, Coalition of Greater Minnesota Cities, the Metro Cities, and the Small Cities Organization to look at updating the formula based on the reflection of time. As you know, the last time the formula got significant update was in 2013, so we thought it was time to look under the hood again with the assistance of nonpartisan staff, including Mr. Arneson, whose contributions were invaluable. The result of that work was an updated formula that was carried in Senate File 3971. We want to thank Senator Klein for his leadership there and carrying the bill, and also Chair Rest and Chair Nelson for your signing on to that bill as well. We look forward to working with the legislature again this year to update and strengthen the LGA formula, as well as to provide an appropriation increase that meets the needs of cities across the state.
Thank you, Mr. Peterson. Ms. Bonney and Mr. Ungaro.
Good morning, Madam Chair and committee members. Sheila Vanny, I'm the Assistant Director with the Minnesota Association of Soil and Water Conservation Districts. Our organization represents the 440 elected SWCD supervisors across the state and their more than 460 conservation professionals. Want to thank you for the opportunity to speak to a provision in last year's conference committee agreement on soil and water conservation district aid. SWCD aid as a standing statutory appropriation of general funds from the Department of Revenue to SWCDs would be distributed statewide to each of the 88 SWCDs and to Hennepin and to Ramsey counties. And it would act similar to other forms of state aid to local government units. The $6 million in last year's conference committee agreement, while a start, was well below the amount we are seeking, which is $22 million per year. It was our understanding at that time that the $6 million was intended to be additive or in addition to other state funds that SWCDs have been receiving. And as Mr. Arneson noted yesterday during the walkthrough, the last 3 biennia, SWCDs have been receiving Clean Water Fund appropriations for our work across the state. Unfortunately, every 2 years, we have faced challenges and uncertainty around whether that funding would be enacted and at what level. And when we get to the end of this current fiscal year, we do not expect future Clean Water Fund appropriations to be allocated to SWCDs. At the $22 million per year amount, SWCD aid would present an opportunity to finally solve a long-standing problem in how the state contributes funding to SWCDs. Madam Chair, I appreciate the time this morning, and we look forward to further discussions as legislative session progresses.
Thank you, Ms. Fanning.
Madam Chair?
Senator Nelson.
Would this be an appropriate time to ask a question of the testifier?
Why don't we finish the testimony for this article, and then I'll
Yes.
call on you.
Thank you so much.
Okay. Mr. Ungaro. So, Ms. Fanning, don't leave.
Thank you, Madam Chair and members. Good morning. I'm John Ungaro, Government Relations Director for St. Louis County. I'm here today to talk about the payment in lieu of tax provisions, or PILT provision, from the Omnibus Tax Bill last year. Speak in favor of continuing this, hopefully, in this year's tax bill. As you remember, the impetus for the reform for PILT actually came from a special study that the Northern Counties Land Use Coordinating Board conducted last year, which showed, that there were some serious discrepancies in what that law has become from the 1979 law that was originally passed. One of your former top tax analysts for this tax committee, Keith Carlson, was the one who actually conducted the study on behalf of the Northern Counties Land Use Coordinating Board. And in true form, Keith Carlson came up with a study that was nothing short of perfection. Rather than get into all the details, of course, in the study, I think it boiled down to a couple key points, and that is he identified that there's 8 million acres of state PILT lands in the state. 95% of those PILT lands happen to exist in the northern third of Minnesota, roughly 22 counties. And what he discovered is that not anything close to a majority, or certainly 95% of the funding for the last decade or so has been reaching those counties where the disproportionate amount of PILT lands exist. It was more like about 10% only of the new PILT funding that was appropriated was actually making it up to those counties where all this public land exists. And this, totally flies in the face of what the legislative intent of PILT is, which actually is stated in statute in 477A.10. It specifically states that, quote, the purpose of PILT is to compensate counties for their loss of tax base because of the amount of state land ownership within their boundaries, unquote. So fortunately, the fix that you were able to put in the Omnibus Tax Bill last year goes a long ways towards resolving the funding disparity that has occurred across the state, and we thank you for that, and look forward to hopefully getting it further resolved this year. And I just want to reiterate, you heard from both the Association of Minnesota Counties and from MICA today. They both strongly support this legislative change. And I've got about approximately 20, I believe, of the 22 individual counties in northern Minnesota who are impacted the most by this have passed individual county board resolutions in support of this change. So again, just want to thank you for the provision from last year, and hopefully you can push the repeat button for this year.
Thank you, Mr. Ungaro. Senator Nelson.
Oh, thank you, Madam Chair. Just a brief question for Ms. Vaney. I noted you stated that you did not anticipate that there would be clean water funding for SWCDs in the upcoming budget. There has been for the last 3 biennial budgets. And I just wanted to know, why do you think that we would not continue on that trajectory of using clean water funding to help fund SWCDs, which that's one of the wonderful things SWCDs do is provide cleaner water. So why do you think after 3 consecutive biennia of using this clean water funding, do you think it will not be here? It will not be, you don't anticipate it coming this session?
Ms. Vaney.
Chair Rest and Senator Nelson, thank you for that question. The Clean Water Fund appropriations come as a package of recommendations from a body called the Clean Water Council, and it has stakeholder involvement from various different interest groups and local government units, including SWCDs, along with the various state agencies that have involvement in water issues. And they have, as a council, never recommended funding for our operations to be a part of the Clean Water Fund appropriations. It has, each of the 3 biennia that you referenced, been a legislatively enacted appropriation outside of their recommendations. As we actually continue, though, on the progression that we're seeing with our transition to watershed-based implementation, planning and implementation across the state, more and more pressure is going to be, is being put on the Clean Water Fund to fund the projects that need to get implemented on the ground associated with what's identified in those plans. And so, excuse me, there's going to be a lot of strain on the funding in the Clean Water Fund to accomplish that in the face of some other ongoing funding needs. SWCD funding, unfortunately, is a more longstanding kind of operational funding need that exists outside the scope, but along and parallel to the work that happens with clean water funds.
Thank you.
Thank you. Thank you both for your testimony. We'll turn to Article 7 now, and 2 people who are appearing virtually. We'll start with Mr. Bob Burns, the mayor of the city of Marshall. Mr. Mayor, welcome to the committee.
Thank you, and thank you, Madam Chair and Vice Chair and members of the committee. My name is Bob Burns. I'm mayor of the city of Marshall. I'm in my 31st year of serving in that role. The city of Marshall is requesting authorization to go to a vote of the people this November to request authorization for the extension of the existing 1/2 cent sales tax. The identical request was considered by the legislature favorably last year also. A 1/2 cent sales tax in the city of Marshall was previously authorized by the voters of Marshall and the legislature for construction of the Red Baron Arena and the Regional Merit Center, both projects that benefited the region. We're nearing the end of the collection of the funds required for both of those projects. So the purpose of this extension is for the construction of the Regional Aquatic Center that would replace the existing aquatic center and swimming pool. That pool is one of the oldest in the state, originally constructed in 1937. The current facility has some serious deficiencies and does not meet the needs of the community. For example, we lose about 12,000 to 15,000 gallons of water each day through the seepage of water through that porous concrete. The mechanical and the electrical system is in need of complete replacement. The bathhouse doesn't meet ADA standards, and suffice it to say that as we did an engineering study, the result of that study was that repair is not feasible. Complete replacement is the only option. That engineering study was recently updated, and the cost estimate that we had last year has now increased by 21%. Based on public surveys, there's strong public support for the replacement of the current aquatic center and to pay for that with the use of local option sales tax. We did a public information survey, and 74% of the respondents did agree with that. The proposed aquatic center is really viewed by the business owners as important for the recruitment of families to the region and eventually adding to the workforce. So finally, I would add, the city of Marshall serves the region for employment opportunities, for education, for healthcare, and for amenities. And the regional aquatic center will serve the regional needs, as most smaller communities in the region do not have community swimming options. So in summary, the request is the authorization to go to a vote of the public, requesting the authorization to extend the current sales tax at the same level and to have that referendum vote this November. I think that.
Yeah, Mayor
Madam
Burns.
Chair. Yes.
This provision was in the conference committee report proposal from 2022, or is this something new?
This was in the committee report last year, the identical request.
And Mayor Burns, have you submitted the proposal details to myself and Senator Weber to be in the 2023 bill? The deadline for that is January 31st.
We have that on the agenda for our next city council meeting, so we will have that request submitted prior to the end of the month.
Thank you very much, Mayor Burns.
Thank you.
And then we have Bethany Brunzell, who is the Assistant Fire Chief of Golden Valley, also on Zoom.
Thank you, Madam Chair and members of the committee. My name is Bethany Brunsell, and as Madam Chair said, I am the Assistant Fire Chief for the Golden Valley Fire Department. And as we did last year, we are looking to get authorization to put a 0.75% local option sales tax before our voters. And this is for us to be able to follow the recommendations from a couple of studies that have been done, one from 2016, one in 2021, that affirms our need to change our staffing model for our fire department. We've been operating as a paid-on-call fire department, and like many fire departments across the state and across the country, finding paid-on-call firefighters is getting harder and harder. So we're looking to change to a a duty crew model where firefighters work part-time. And in addition to that, we need new stations, and to right size our department, we currently have 3 stations. We're going to go down to 2 fire stations, and those stations are not currently ideally located. So we're looking to relocate our public works facility and build a new fire station that would accommodate current modern sized vehicles, better safety, cancer prevention, gender equity, incorporate some training capacities, and really bring our public safety up to current best practices. We're looking for using a local option sales tax as one of multiple funding revenues for this, because we recognize that public safety benefits more than just our Golden Valley residents. Anyone who works, visits, drives through our city can benefit from public safety services. So this is something that has a benefit beyond just those who live in the city of Golden Valley. So a local sales tax helps share that burden a little bit to help improve our public safety for all of our residents. So thank you in advance for this consideration, and thank you for your time, committee.
Thank you. Has the city of Golden Valley submitted its information to myself and to Senator Weber?
I'm not certain. I will check on that, and we'll make sure we get that submitted by the end of the month.
Thank you very much. Mr. Solberg and Mr. Bernstein again. And I did notice on the Zoom, we would appreciate it and if when you are using Zoom and signing in on Zoom, that you use both your first and your last name and not just your first name, please, just as a protocol. First and last names when you're on Zoom, when you sign in. Mr. Solberg.
Good morning. And thank you, Madam Chair and members of the committee. My name is Lawrence Solberg, and I'm representing the city of Grand Rapids. I wanted to have the city administrator here today, but he is in Hawaii, and I thought maybe you shouldn't fly back for that. So you're stuck with me.
Couldn't get off the ground, apparently.
Yeah.
Nowhere in the country.
Yeah, but I thank you very much for the opportunity to address this issue. City of Grand Rapids received permission in the 1921 legislative session for a local sales tax to help fund repairs of their IRA Civic Center. The building includes a hockey arena, is used by the high school for many activities and the community, and is used throughout the year for other events. Originally built in the early 60s by the community itself, by volunteers, both for material and labor, it is now owned by the city. The roof is a traditional dome type of roof, shape that has a classic beam support. The beams are old, but they've been in water, moisture a lot over the years, are underrated to support the weight, and one actually broke. Luckily, it fell against another one, so the whole roof didn't fall down on people. Thus, after some temporary repairs, the community continues to be able to use it with a sign on the door that says, "Enter at your own risk." The roof is not really strong. They also must remove all snow all the time to keep the weight off the roof. The city has estimated that had estimated that the repair and building of the roof and also to do some ADA and other activities to replace 2 old compressors so they have new refrigerant, fix the cement floor that has holes in it, the pipes that are underneath it, would cost about $10 million. They've cut back on much of some of their other needs, such as a parking lot, and to provide, they're not providing another viewing area for the hockey. Again, the estimate was to construct, everything was about a little over about $10.5 million. They received about $5 million of that in bonding, and we're asking local sales tax in 1921 for a $5 million. Unfortunately, the original cost, and sometimes communities do this. I've noticed that they're very reluctant to ask for very much money. They want to do as little as possible. And I think their preliminary estimate was under cost, and then of course COVID hit and all the other things that go along with the increased cost. They are now under construction for the building, and the cost is about $15 million. So they're about $5 million short. Last year, they asked for local sales tax extension of both $5 million and also of length of time. Since the legislature did not pass, and they have authority, they had to have authority to do the vote in this last legislative session, they went with the $5 million that the legislature had approved, and it passed by over 75%. But they still are $5 million short. If last year's legislature would have passed, I think that in that particular bill there was a provision for them, I think, for $3 million. And we thank the Chair Nelson for that particular provision as well. That would have really helped. I know this is a unique situation for this community and a few other communities. One that the contract has already been let. Secondly, that the project, the vote had to be taken this last legislative session. And so it is a unique situation. I don't have a good solution for it, but I hope that we can work with the legislature, the chair, and the legislature to find a solution for this and a few other communities that are in that unique situation.
Thank you, Mr. Solberg.
Thank you.
Again, has Grand Rapids submitted its information?
They passed a resolution before the administrator went on vacation, so I think it's in the mail.
Well, The two of us hope so.
Not two of us. We'll make sure it is.
So thank you very much.
Thank you.
Mr. Solberg, Mr. Bernstein again.
Chair Rest, members of the committee, just to remind quickly, my name is Eric Bernstein. I work for a labor grassroots coalition that's united in our dependence on public revenues, who in turn we are dependent on for many public services, from schools, long-term care workers, infrastructure, and much more. I rise to speak about local option sales taxes because we feel it's a really powerful illustration of the state's unmet public investment need. And I was really sitting here listening to Mr. Solberg. I thought there was really no better metaphor for the point we were trying to make, talking about lost, than this public, a center of community that's in bad need of repair. I think there's examples like that all over this state, and I think that the rise in local option sales taxes are really an illustration of that. In the late 90s, all loss totaled $100 million about statewide, and now it's $700 million. As a share of the state's economy, it's nearly tripled from 0.07% to 0.18% of the total state economy. So this is localities expressing their need for public investment. And I think it can be hard to doubt that there could be more public need when we look, at a budget that does grow along with the economy. But I think when we hear stories like that and many others from all of the different loss provisions that we had in the conference agreement last year, it becomes very clear that, communities need repairs, need many things. And not just things that they need, in there's a beam falling on our heads scenario, but also things that they want that enrich life, ice rinks, trails, campgrounds, and things like that that are included in the list of provisions that we had last year. And so we think that all communities should be extended these, funding for these sorts of programs, whether it's through LGA, CPA, or other sources. And so just using, just want to reinforce that we think this is a very powerful example that all communities need and deserve nice things, and that the government needs to protect the tax base to pay for them. Thank you.
Thank you, Mr. Bernstein. Article 8, Ms. Madden, Mr. Dahl, and then we have two people on Zoom. We'll start with Ms. Madden.
Thank you, Madam Chair, members of the committee. My name is Nan Madden. I am director of the Minnesota Budget Project, which is a program of the Minnesota Council of Nonprofits. Our mission is to identify and advance public policies to make Minnesota a place where everyone can thrive, regardless of who they are or where they live. The renter's credit expansion proposal in the 2022 tax agreement would be a real game changer, and I want to thank Senator Nelson, Senator Weber, and Senator Rest for including it in the work of the Tax Conference Committee, as well as to thank Senator Klein and Senator Dietzick for their past work on renter's credit. The proposal in the tax agreement would make two important changes to the renter's credit, which is a income-targeted property tax refund to renters who meet certain income and cost requirements. The two changes are, first, simplifying the income definition used to qualify for and calculate the renter's credit, changing from the complex household income measure to a more common adjusted gross income measure. And you heard a similar change regarding the K-12 credit. Secondly, it would convert the renter's credit to a refundable income tax credit that folks would apply for on the state income tax form, replacing the separate process for applying later in the year that we have currently. These combination of changes would have several high-impact results. An estimated 120,000 Minnesota households would start receiving the renter's credit. These are Minnesotans who already qualify, but face barriers to receiving it through the current mechanism. The dollars would also get to renters sooner after they file their income taxes rather than later in the year. Changing the income definition to adjusted gross income makes it simpler for Minnesotans to apply for and for the department to administer. And more than 60% of currently eligible households would qualify for a larger refund than they currently receive because of that change of income definition. These game-changing outcomes would occur while still maintaining the sliding scale structure of the renter's credit that prioritizes lower-income Minnesotans and folks whose property taxes are particularly high in relation to their incomes. We and our community partners are excited about the benefits of this proposal. We also look forward to working with you on potential outreach and education efforts that would come along with the implementation of this proposal to reduce unintended negative consequences for Minnesota renters who are used to budgeting for receiving these resources in the fall. Thank you for the time.
Thank you, Ms. Madden. Mr. Dahl.
Good morning, Chair Rest and members of the committee. My name is Michael Dahl, and I'm the Public Policy Director with Homeline, a statewide tenant advocacy organization. I'd like to thank you for the opportunity to speak in support of the expansion of the renter's credit that was proposed in last year's Omnibus Tax Bill that didn't cross the finish line. Homeline runs a statewide tenant hotline. We offer free, confidential legal advice, receiving over 15,000 calls each month. In these calls and in our direct organizing with renters, we know what a critical asset the renter's credit is. It helps households struggling to afford basic necessities. This is so often not money that goes in a savings account. It is used to spend money within their community for things they need. Things like school supplies, clothing, non-perishable foods, toiletries, cleaning and laundry supplies, and well and far in advance of the holidays, gifts. Also, the renter's credit is used to buy more expensive necessities like insurance, car repairs, eyeglasses, dentist visits, medications. We know this because we've asked, and they've told us what they use these resources for. Because of that, we are in support of the expansion of the renter's credit that Nan Madden referred to, and we'll work our darndest to make sure it makes it into this tax bill, next year's tax bill. The last point I would like to make is that affordable housing is in a structural problem, and therefore the renter's credit, while it is extremely helpful, it can't be the only approach we take to addressing housing needs in the state. According to a report from the National Housing Coalition, in Minnesota, there's 169,000 extremely low-income households, yet only 69,000 units of housing affordable to them and available to them. That leaves 100,000 units that are not available for this population. Furthermore, according to the report from the Minnesota Housing Partnership, a State of the State's Housing 2021, the costs are continuing to increase to disproportionate income. Between 2000 and 2019, the median renter income in Minnesota increased by just 1%, and the gross median income increased, median rent increased by 14%. There's no wonder there are thousands of Minnesotans experiencing homelessness each night in Minnesota. Therefore, we need other committees, capital investment and the Housing and Homelessness Prevention Committee, to address what is really a structural problem that we need covered in those committees. Thank you for your time, and I'm happy to answer any questions you may have.
Thank you, Mr. Dahl. On Zoom, we have Mr. Valenzuela from Prepare and Prosper, one of my very, very, very favorite organizations that I was a volunteer for, well, a number of years ago, helping low-income and senior citizens prepare their, generally they're very modest income tax returns and property tax applications for the M1PR and the renter's credit. Mr. Valenzuela, I'm happy to have your testimony.
Well, good morning, and thank you for having me here, and also thank you for volunteering and supporting organizations like Prepare and Prosper. Chair Rest and members of the committee, thank you for allowing me to join you and testify in support of several provisions in the 2022 Omnibus Tax Bill. My name is Alejandro Valenzuela. I'm the Tax and Financial Services Director.
Mr. Valenzuela, you do need to say your name for the record.
Oh, I'm sorry. Yeah, it's Alejandro Valenzuela.
Thank you.
Yep. I'm the Tax and Financial Services Director at Prepare and Prosper, Minnesota's largest volunteer income tax assistance program. I've worked with the organizations throughout the past 4 tax seasons, and over that time, I've had the honor of working with thousands of low to moderate income taxpayers and hundreds of volunteers each year. It is core to Prepare and Prosper's mission to assist Minnesota taxpayers in filing an accurate tax return and claiming the tax benefits and credits that they may be eligible for. I and my staff appreciate the simplification of an expansion of the several tax credits in this tax bill. Our primary reason for testifying today is support of the proposed changes to streamline claiming the renter's credit. This would be beneficial to our taxpayers that Prepare and Prosper supports. I speak for PMP, and I'm extremely supportive of the change in the definition of the household income to more closely align with tax filers' adjusted gross income, AGI. The consistency of using AGI will decrease confusion about how the credit is calculated, increase accuracy of the tax return prepared, and minimize return follow-up required by the Department of Revenue. Adding this return to the state's income tax return, adding this change to the income tax return would deliver renter's credit to filers earlier in the year and be more predictable timeline than the summer distribution of the tax, the current refund at this time. Shifting the renter's credit to income tax return and removes administrative barriers that filers face when preparing their own tax return and the renter's credit. Many tax software vendors require renters to print and mail the M1PR form. This is an extra step that can cause taxpayers to miss out on the credit because they didn't know that the form was needed to be mailed, or cause taxpayers without easy access to printing or opt out claiming the credit. There are a few other items in last year's legislation that I wish to acknowledge as steps forward equity and making a tax system that works for all Minnesotans. Thank you to last year's House members and tax conferees for proposing an increase to the number of families eligible for the credit, the working family credit, and adjusting the definition of who qualifies to claim the homestead classification. Also appreciate move to support Minnesota students, ages, updating the K-12 education credit and making the student loan credit refundable. Thank you again to the committee and for the opportunity to testify today.
Thank you, Mr. Valenzuela. And so we're going to move on now to Article 10. Ms. Jenner?
Thank you, Madam Chair, members of the committee. My name is Rachel Jenner, and I am the Executive Director of Allied Charities of Minnesota. I'm here today in support of reducing the combined receipts tax on charities and lawful gambling. We are thankful for the support and leadership of Senator Nelson, who introduced our tax relief last year, and we sincerely hope to be included in this year's bill. In 2022, our charities donated $139 million in their communities. And on a local level, these donations have a big impact. They're supporting communities statewide by funding veterans programs, youth programs, food shelves, fire departments, and a number of various local programs that have no other funding. We are very proud of the work we do locally and our ability to serve in so many ways, but many organizations are struggling to fund programs and charitable requests because of their heavy tax burden. These 1,100 organizations paid $180 million in taxes in 2022. That was a 50% increase from the year prior and a 100% increase from 2020. And just to note, we did not have a decline in revenue or taxes in 2020, despite the pandemic. Importantly, our taxes were $40 million more than we were able to donate. We are looking forward to seeing a change in 2023. A decade ago, we were asked to implement and grow electronic pull tabs to fund US Bank Stadium, and we have done that. As our business has grown, so has the burgeoning fund for the stadium. And now that it's fully funded and our annual taxes are providing 6 times what's needed to make those bond payments, we feel it's time for us to be released from the tax burden by reducing our rates across the board. Taxes are the largest expense that we incur, and we are uniquely limited with pull tab sales in that we are not able to pass on any increased cost to our consumers. I can't sell a $1 pull tab for $1.25.
So with inflation and climbing labor costs, our margins continue to get slimmer each year. This year, we are anticipating paying $200 million in taxes. So I encourage you to support reducing all the tax rates on charitable gambling. Thank you for your time and consideration.
Thank you very much, Ms. Jenner. This concludes the testimony that was asked for and on that memo. And now just say we have a few minutes. Is there anyone who wishes to testify on any article that has not had the opportunity to do so and would like to? Thank you very much. I can't tell you how much I appreciate your willingness to come today and to be brief and succinct, although it was very clear that some of you were testifying on bills yet to be introduced and/or going to be reintroduced, the values of them, rather than just recounting that you simply support those provisions. That would have been sufficient, but we ended up, because people were very kind to one another and got through, 2 pages of testifiers, and we still have 10 minutes. I'll just take one of those to reiterate that we will be hearing a presentation on Senator Putnam's bill tomorrow on Social Security and pension income subtractions. We're only going to hear one bill, but we will list on the agenda other bills and their chief authors that have come before that have been introduced already. So just one bill, and but we're going to make sure that others that have been introduced are acknowledged. And then next Tuesday, we will hear testimony on it, and then if there are any amendments, entertain those, but then in general, we'll lay the bill over for, not take any votes otherwise, and lay the bill over for consideration in Omnibus Bill, as is our general practice. Senator Nelson.
Well, thank you, Madam Chair. I just wanted to take a moment and really thank you for providing the full public review of the good work that the conference committee did in 2022. And I particularly want to thank you for your participation in that, on that committee, and Senator Weber. And I think it looks like many of the good things that we worked through and accomplished will not be starting from ground zero. And I think this, it was an important hearing, and I want to thank you for setting that groundwork for us.
Sure, you're welcome. Anyone else have a comment? Senator Weber.
Do you have any update on the item we talked about last night?
No, I do not.
Okay.
Okay, and I don't mind making a public statement about it. We did get some information from the Department of Revenue that there needed to be a correction, a slight one. I am presuming, based on that conversation, to the revenue estimate on the conformity bill. And we are awaiting that information so that it will be available to members on the floor. I haven't had a chance to speak with either Senator Johnson or Senator Dietzick about the circumstances under which then we will take up the bill. I am absolutely reluctant to take it up without an accurate revenue estimate, and we'll see how they take my advice, put it that way, okay?
Thank you, Madam Chair.
So I think that's it for us today, and there being no further business before the committee, we're adjourned.